I'm Jeni Brown. Welcome to the latest in our series of Meet the Lender. And this time around, I am delighted to be speaking to Nathan Chand, who is a business development manager for One Savings Bank. Now, One Savings Bank is a name that most of you watching this are going to be thinking, who on earth is that? But One Savings Bank actually is a group of lenders, and some of the names you'll absolutely recognise. The two key ones being Precise Mortgages and Kent Reliance. They also have within their group Interbay as well. So in terms of kind of keeping it mortgage focused towards the landlord community, Kent Reliance is kind of where we're going to kind of keep our attentions on this particular interview. Now, Kent Reliance are a specialist lender. They've been lending for a really long time. They're very, very good. And I think they serve the landlord community very, very well. So they've always been in the market, for example, for HMOs, multi-units and limited company lending. They don't have a maximum number of properties in the background. They don't have a minimum income requirement. They can also consider people with a slightly imperfect credit record as well. So an example of that would be if you missed a mortgage payment 13 months ago and there was a good reason for it, they can certainly consider lending to you. So loads of good stuff within their criteria. Also just a thoroughly nice bunch of people as well. So I was really happy that Nathan was able to come and speak to us. Nathan, thank you so much for joining us today. It is so lovely to see you as always.
Likewise.
And we've got a load of questions to run through with you today. So we're going to jump straight in if that's okay. And I'm going to start off by asking, who would you say is a typical borrower for One Savings Bank?
Ooh, I don't think any two borrowers are the same, but I'll offer two sides of what we see most commonly. So you've got your really professional landlords, those guys that know their markets well, different kinds of tenancies, great relations with trades and specifically a broker or brokers in some instances. And then on the other side of that, you've got individuals that are entering the market for the first time. So either accidental landlords or people that want to enter the space and begin growing their own portfolio, their own sort of thing.
Cool. And I think what I immediately want to respond to that comment is because there are still people that actually want to come into this market in spite of everything, aren't there?
Oh, absolutely, definitely, absolutely.
Would you say that the split of new entrants versus portfolio landlords, have you seen any notable shift one way or the other?
There's definitely a shift in how the market is growing. Contrary to popular belief, some individuals think that it's going to change drastically with a few different approaches and regulations that are coming into play. But I think, and a lot of other BDMs and different lenders think that it's going to grow, but just not in the same kind of space where you would typically see that growth. I'll touch on it probably a little bit later on, but I know that no doubt you'll ask me a question on it, but there is slight nuances. It's definitely still a growing market.
Okay, well, let's see if we can come back to that a bit later on. So if I was to ask you what sets your OSB, your lender, apart from others, your three sort of key selling points, what would you say they are?
Okay. Under OSB group, you've obviously got a few different kind of specialized areas. So Precise, typically you're bridging and residential. On the residential side for Precise, because I look after the term lending, I think that they're certainly an adverse lender, so really good adverse proposition in terms of up to 5 defaults and 3 CCJs registered within the last 24 months. There doesn't have to be a monetary cap on that. They don't have to be satisfied. So individuals who may find themselves in a bit of a difficult circumstance could have an offer. But where a lot of people miss out with Precise is that they're really good on first-time buyers. So 95% loan to value, can add the fee to the loan. So technically it's 97%, but we're assessing affordability on 95%. I mean, recently they came out with 6 times income multiples as well, which is huge. They're great for your self-employed clients. So always looking to go based on latest year, 99.9% of the time that is. And then for Kent, you've got typically your buy to let proposition. So really quirky stuff in terms of up to 20 bed HMOs, up to 20 flats on one freehold, really intricate portfolios and and even for your first-time borrowers that are entering that space, still a position for them. But then even further diversified for that, you've got our sister company Interbate that look after the commercial and semi-commercial space, and that's growing as well for multiple reasons. I mentioned Kent. Take this with a grain of salt. Kent is likely to change. We've invested a lot of time, research, resources into developing a brand new, all-intuitive, real-time decision-making platform, but to an entirely different lender called Rely. And that lender is going to cater for the buy-to-let space in particular, and buy-to-let lending only, to kind of coincide with a few of the changes that are coming to play and changing the way in which the market is sort of functioning, really.
Sounds exciting. Can you go into any more details?
It's a work in progress. The market, I'll shed some light. So we did go out to the press and say we are going to be launching a new lender. In terms of what everything you're familiar with Kent from like a USP perspective, imagine those bells and whistles, but slightly more refined. So I just mentioned 20 flats on one freehold and 20 bed HMOs for Kent, really quirky setups. Well, there's no cap on your number of beds for HMOs. There's no cap on your number of units on your multi-unit blocks. Kent normally have been quite set in stone in terms of the rate. The same rate that you'd get on a single family let would be the exact same rate that you would get on a multi-unit block or a HMO. However, that's going to change. So rates for your more entry-level landlords or more vanilla landlords will coincide with the likes of other lenders. BM Solutions would probably be a great example, but rates like that will be available through Rely for your more vanilla kinds of deals. But then when you do get into the quirks, or perhaps there is a touch of adverse, because there's still going to be an appetite towards adverse, then of course you've got the other side of the spectrum where the risk appetite, I would say, has increased with those no caps on, the number of bedrooms, no caps on number of units, etc. So there's that part in terms of overall proposition and positioning in the market. But then the main bit, which I think brokers are going to love, once it is live and out to the rest of the market, is going to be that platform, because it should make keying cases from start to finish, offer even to completion. It should be considerably better than what the rest of the market is currently used to, especially if they've been using Precise or Kent for quite some time.
I find it really interesting, actually, because when we're doing these Meet the Lender sessions with lenders, and they often reference their sort of systems, and I suppose as a kind of, if I was a landlord watching this, I would think, well, that's the broker's problem. How does this benefit me? But actually, if a lender has a good platform, it really does actually make the application process, or it should do, much more frictionless in terms of the ability to do AVMs, potentially, and be able to maybe lean on, I don't know, open banking. And so these things that actually, where people have been historically producing reams of paperwork as a borrower, and it is frustrating for people being asked for loads of paperwork. Actually, the borrower, the landlord, stands to really benefit as well. It's not just the broker whose life's been made easier, it's actually the borrower as well.
Exactly that. From even just timescales, like you mentioned, VAS panel, or like physical valuations, AVMs, all of that kind of stuff is going to be built in, so that when you do go back to your client, you'll know everything that's associated with the case, whether it does need an AVM, whether it does need a physical val, the fees in terms of your admin val fee, etc. But more to the point, on this new system, and something that I'm really excited about, because I know that we've lost quite a few deals on this aspect, but given that this is going to be in-house and we can consistently improve it and put our own spin on things, the ability to, at some point, if ever it's necessary or needed, to offer, free legals or free vals, something that we were never able to do previously, we should be able to do. Once the system is live with Rely, the ultimate goal is then to get Precise onto this platform as well. So that process then becomes a breeze. And then it will be to get Interbate onto that platform. So all of our brokers and intermediaries will just have one set login, one password to remember, which I don't doubt is going to make everyone's lives a hell of a lot easier. and then you just select a drop down in terms of what kind of case you'll be submitting. Everything will be able to be done off of that one platform, which is going to be a huge thing when it does go live.
Sounds amazing. Okay, so just thinking about then, so most of the people who are going to be watching this video are going to be landlords, therefore they're really kind of predominantly sitting within the Kent Reliance Rely brand. So just thinking back to what you said, so one of the things that will really set you apart, and actually it will set you apart, is the fact that you'll have no limits on number of rooms or number of self-contained units. That's definitely, without going into the commercial space, I should add there, so that's a really kind of good USP. One of the things that we particularly love about Kent Rely when we're doing limited company lending is the fact that you do not take personal guarantees, and therefore you broadly just ignore within a company structure everyone other than the company directors. Is that right?
Correct. Yeah. So it's still going to be for Kent, and even when Rely's live, we'll only ever underwrite the directors. So it's only the directors that need to be named. That layered limited company structure is becoming quite prominent. I mean, limited company stuff was prominent anyway, but then in the ways in which they're set up in terms of shareholding, beneficiaries, etc., layering, all of that is quite nuanced under an accountant's advice. But for all intensive purposes, we're pretty much fine with company layering. Pretty good with it. Even if, you know, a percentage of that company layering, let's say, is from a company that's based abroad, from a shareholding perspective, that's fine. There's obviously a few quirks and whatnot that I won't go into much detail with, but for the most part, in terms of what we can consider, then it's pretty popular and quite common, and we're good with it.
Good, lovely. Thank you. Right, so moving on now. So obviously you guys are, and we see this, you're very keen as a kind of group to try and be all encompassing. So having an offering that could be sort of a service to all types of borrowers. But surely you are declining applications as well, Nathan. Well, just mainly sticking to the Kent brand now, I think is probably most relevant. What would you say is the sort of main reason or the most common reason that you guys have to decline applications?
Okay, from my entire time with with the group, I would say, especially having underwritten for them before, the most common is undisclosed adverse or something which is picked up in the underwrite stage down the line. So whether that's, you know, on a bank statement for portfolio landlords, whether that's something that's, you know, internal, or even on associated companies. So might put a limited company case in. Obviously, we then do our own checks, find an associated limited company for the client, and then there's adverse associated with that company. Unfortunately, that's probably the main driver that kicks some cases out for us, unfortunately.
And I think that is actually a really good example, because often we find people come to us with limited company applications, and they would assume that company is totally disconnected from any other companies that they have been associated with or are associated with. And then, so if that company has particularly gone into liquidation, for example, people kind of think that lenders aren't going to find out about that. But unfortunately, and we've just been banging on about the virtues of great technology, that is actually stuff that lenders can kind of get at quite easily these days, isn't it? So it comes to the surface.
Correct. It does. It does. That's the main driver. It's the main one that we see time and time again.
Yeah, thank you. Okay, so we're talking about kind of service and using technology to make the application process really kind of quick and easy. In terms of, I guess, in readiness for making an application to yourselves, how would a borrower ensure that they were doing as much as they can from their side, at least, to make sure things went nice and quickly and smoothly?
I think this is where a client and their relationship with a broker comes into play, because a good broker, I think, is worth their weight in gold. Reason being, they've got access to the whole market, but more to the point, they have an understanding of that market, but they also have great contacts to those individuals at those lenders across the board. So having access to a good broker is the first thing. And secondly, because of that access, that broker then ultimately understands the client's wants, needs, specifications, what they're after, what they can do, what they can't do. And ultimately, having that information, having that knowledge as part of that KYC process, you then got all the tools you need to basically figure out what you can and can't do.
Yeah.
So this is where I actually think that brokers, good brokers at that, are definitely super important for the entire process.
Thank you. Do you know, it's actually fascinating. We pick up so many clients who have been making applications through different brokers, and then it's kind of been knocked out by the lender. And often it's not that the client hadn't actually divulged the information in the first place, it was the broker hadn't picked up on the fact that this might be relevant to that particular lender, and so then they're getting knocked back, and then they sort of come to us and say, I've had this really bad experience. So actually it's a really interesting one that you've picked up on there. And of course, if anybody watching this would like to give us a call, the number is 0345. Okay, thank you. Right, Nathan, next question. Next question for you. So moving away from one savings bank and mortgage lending, and now thinking more about the broader landlord community. And as you kind of referenced a little bit earlier on, there's a lot of change coming down the road at the moment for landlords to try and navigate. And I suppose as a lender, you're going to be looking at, particularly thinking about the Renters' Rights Bill, for example, and also we've got the EPC changes that are kind of, there in the background at the moment. Are you having to change the way that your lending is done, your credit risk appetite, in anticipation of any of these changes coming in?
There's definitely a shift, but I think that's going to be, you'll start to see that across the board with all lenders, I reckon. There's obviously a shift in our sense because we're launching an entirely new brand, which is going to, kind of cater for these changes, or at least coincide with them and encourage them and whatnot. But I think there definitely is a bit of a shift. You might find, this is just me offering my own opinion on this now, I think you might find that from an underwriting perspective, especially in the early days, like during a transitional sort of phase, that there may be an air of caution or a bit more rigidity around policy in general. But I think that's probably the main thing for now. I don't think it's going to encourage a drastic change, but definitely an air of caution and then movement to kind of grow with the space and how it's going. I say movement to grow with the space and how it's going, just as a slight segue onto something a little bit different. Whilst these regulations and tightening are coming into play, obviously individuals will adapt from a lending perspective, but even from your landlords, they'll then start diversifying it, because I'm seeing it, we're seeing it in terms of, you've got individuals that have been in the game for quite some time, a very well established residential portfolio, but they're starting to dip their toes into commercial and semi-commercial. Mm-hmm. Don't get me wrong, it's not necessarily my field, I'm by no means an expert in it, that comes with its own risks, but by the same token, you're looking at longer leases, arguably a better yield. Commercial has stayed pretty stable and is still growing. There's less regulation around that, so you'll start to see portfolios diversifying, I think, for sure as well.
Yeah, do you know what, we so interestingly, we did one of these with Marilyn Edwards from MT Finance, who've kind of rejuged their commercial offering, and they're saying exactly the same thing, that actually, particularly semi-commercial, I would say, is a really good stepping stone if you're looking to try something new. There's obviously different taxation rules that sit around commercial, and also the kind of tenancy types as well. So I do think that would be a growing sector for sure. But I wonder, so for example, there's a lender who I'm not going to name, but we have definitely seen since the announcement of the Renters' Rights Bill and sort of formalisation of what's going to be contained within it, they're sort of clearly quite cognizant of the fact that landlords might be slightly less protected in the event of a tenant not paying their rent. So obviously the kind of ability to remove the tenant from the property is going to be, at least to begin with, more protracted. Yeah. And also the point around ASTs going and a rolling tenancy kind of arrangement being in play. So what this lender's doing, as an example, is definitely now saying to us, how much savings does the client or the borrower have? So I guess they're trying to sort of understand that actually if it all did go a bit kind of pear-shaped for a while, how is this person going to manage to cover things? But
Yeah.
that's not the noise you're hearing internally at the moment from your side.
No, in terms of how this is a really good example, but the group in general, from like a buy-to-let lending perspective, more so with Kent than Precise, but both at the minute, because those lines have always been blurred, but they can be a bit more specialized in each field, as I've kind of touched on. But when the sort of lockdown had happened and COVID had kicked off, and I think we took an approach of whereby we wanted to see, X amount or just a decent cash flow in savings or some money aside, which in the event of, tenancy issues, or at the time you had tenants that were unable to make the full payment of their rent, or, if any payment at all due to job losses, etc. But I think we'll kind of stick with seeing that. I'd be very surprised if we didn't, especially the way the tenancies are going. So that kind of risk-based approach that an underwriter would have, or that we may ask for on a case-by-case basis, especially when this new intuitive system is in play, I would probably think is going to stick, just to be on the safe side. So again, that kind of mirrors to my air of caution, which I thought some lenders might take, but definitely around that rolling tenancy. But again, for us, it's something that's been in play for years now. So I don't think it will change too much.
Good.
Yeah.
You are on to your final question, Nathan.
Lovely.
And this is a really broad one. And it's, I think the temptation is always to say really great things about the private rental sector here, because obviously we're all in it as a kind of job. But genuinely, what do you think the future looks like for the private rental sector?
I think that it is going to improve on two parts. One part, I think, I would argue for both tenants and landlords, and I'll explain why. For landlords, I think there's going to be, especially those, who treat it like a business and want to grow it and keep it going, etc. All that's going to happen, I say all that's going to happen so loosely, what's likely to happen is that the quality of property, so when it comes to EPCs, efficiency, how a property is presented in general, that quality is going to improve considerably, because naturally that's kind of the way that the market's going. It's becoming a lot more professional in that sense. And then on the second side of that, I say tenants, there's a lot more flexibility for them. The rolling tenancy, for one example, but just given the market and how rates have been, choppy would be one way of describing it, but then also they're slightly higher. House prices for actual purchases are slightly higher. So renting is still going to be, whether that's super short term or in the vast majority of instances, a long-term tenant, that's still going to be very prominent as we move ahead. There is going to be growth in the sector, but it's just a different kind of growth. It's growth in quality. It's growth in maintaining tenant relations and keeping tenants in for, longer periods of time, albeit they're saying, yes, it's rolling. Not many tenants stay in for a month and then go the following, especially if the quality of the property is going to be there. So that's one thing. But again, I know I touched on it prior, but you're probably going to see some individuals exit the market because of how much more regulation there is. But by the same token, those that are still in the market, they'll move with it, but they'll also diversify. So they'll go into things like commercial, semi-commercial. I think we'll see a massive uptick in bridging. We have already, but I think bridging will then start seeing an uptick in terms of auction purchases, chain breaks, refurbishments, and then bringing them up to a certain standard. I think all of that is likely to improve and still grow in general. So still a growing market, contrary to some of the anxiety around regulations coming into play.
Yeah, I hope you're right, actually. I think always the thought of these things is worse, and actually once it comes out in the wash, often it isn't as bad as people think it's going to be. So let's hope that actually once it has come through and it's in action and people can actually experience what it actually means for them, they'll find it to be maybe even in some cases, as you've mentioned, a positive. And they all don't decide to exit the market in mass. But you're right, there's a lot of reporting on this and it's not helpful because it's not actually strictly true, most of it. So anyway, I won't start ranting about people like the Daily Mail because this isn't the time for it. Nathan, you have been an absolute superstar. Thank you so much for coming and having a chat with me today. And as always, it's an absolute joy to spend some time with you. Thank you very much.
Likewise. Thanks for having me on.
So there you go. One savings bank, Kent, Precise, Rely. It's a bit confusing at the moment, I know, but actually good things are certainly coming from that brand. I hope you found that helpful. And we've got lots more Meet the Lenders in the pipeline for you to watch. If you have any questions about this episode or any of our episodes, or anything you'd like us to kind of include with it, any lenders you'd like us to particularly meet and talk to, just let us know. You're welcome to drop us a note, inquiry@mfbrokers.co.uk, or you can give us a call, 0345 345 6788. I'll see you again next time.